Let's begin. I am Jerry Pierce. I work for the Cooperative Extension Service, Kentucky Farm Business Management Program. We're headquartered in the Ag Econ Department. We work with farms on their income tax, their business, their management, their decision-making. We work with 8 specialists across the state, the Commonwealth, and you can see where we're located. And we have the access to farmers' records, financial and production and income statement records. We can aggregate those so that we're not sharing anybody's personal information. We can use it for education, research, extension work, and best of all for them, we get to go back and help them with that decision-making using real numbers. I've been around for 35 years in one state or another, mostly the state of disarray, working with taxes and the same kind of program in several states. We're going to talk about 4 things today, 2 government programs, CFAP and PPP, 1 major topic in income tax, what you would normally call hobby loss, and then some updates within the tax system, some things to be aware of as you're headed toward the March 1 deadline for many of you. USDA is where you're going to find the first one, the Coronavirus Food Assistance Program. Let me back up. The first program came out was authorized, CFAP 1, we call it now, back with the CARES Act in March of 2020. May of 20. In September, President Trump and the Department of Agriculture announced additional dollars for those who continue to face market disruptions, as they call it, and associated costs. In other words, we're not doing so well because of COVID-19. The sign-up began on September 21st and it ran through December 11th, 2020. You're either signed up and in the program or not. I'm going to reference, or I'm going to give you the references there to Will Snell and Kenny Burdine's article in the Economic and Policy Updates on our Ag Econ website, and More Government Money on the Way for Kentucky Farmers by Will Snell. They have contributed a great deal to the CFAP discussion here. All right, January, on the 19th of this year, USDA announced additional CFAP payments. They're going to spend what's left over from the first 2 rounds to help out some of those producers who received funds already. The payments will come first. We're going to look at producers with crop insurance, those who didn't have the APH numbers from 2020. They're now USDA is 100% of the 2019 ARC County yield instead of the original 85%. That applies to these crops, some of which you grow around there, and it allows you to modify your CFAP 2.0 application by February 26, 2021. So in about 11 days, it's all going to be over. It also includes specialty producers, those who already qualified for the 2.0 as sales-based commodities. It would take care of, it allows adjustment for 2019 insurance indemnities, NAP payments, and WIP plus payments. Again, you would modify your existing application by February 26, 2021. Those special producers, NAP, of course, that's the Non-Insured Crop Disaster Assurance for Assistance Program. It would include grain and forage crops and tobacco. On January 29th, USDA announced it had suspended processing and payments under CFAP 2.1 and has halted implementation of the program until further notice. It's not uncommon, but USDA has frozen the payments and everything because the White House, the new administration, is reviewing late Trump administration legislation and in regulatory view. It's not uncommon. It is their right to do that, and they will look and see, does it fit their agenda. The local offices are continuing to accept applications. That's at least what we understand during this evaluation period. So don't let the freeze stop you from making the application or modifying your application. In the meantime, right at the end of the year, there was a new stimulus package passed. It became law on December 27th. This is what we commonly call now CFAP 3.0, a new round, a third round of CFAP payments, and it will open up for application and processing and payment. As far as we understand, it's $20 an acre. It would include $20 an acre for row crop producers and $7 to $63 per head for cattle producers. That's based on American Farm Bureau's calculations. You can see other calculations out there, but basically it depends on what stage of the program your cattle are in. The payments to their payments to specialty crop producers, supplemental dairy margin coverage program for small to mid-sized dairies, and payments to those livestock and poultry producers who had to depopulate because of the supply chain disruptions from COVID. Those things were added in. Again, January 29th, USDA announced that it has suspended the processing and payments under CFAP, including the additional assistance, and as we understand it, 3.0. Call your local office for more information. That's the best advice I can give you. Let's switch over to the PPP loans. This is administered by the Small Business Administration, SBA. It's part of the Economic Aid Act that was authorized at the end of the year that allowed the SBA to reauthorize and to reauthorize and make modifications to several of their regulations, and it's a benefit to the farmer, a great deal of benefit, and it also authorizes a second round PPP loan. So before we go any further, they changed, or the new law addressed a couple of issues questions we had all during the year concerning the PPP program. If you're not aware of it, the PPP loan is a forgivable loan. That is, if you meet the qualification, you get the loan and you meet the qualifications, you can just not include the income in the loan in income. So that's a zero, no income if you qualify for that forgiveness. Apparently Congress said the expenses that go along with that, what you spend the money on, ought to be deductible, but the Treasury Department interpreted that otherwise. So you didn't have to pay tax on the money that you received, but you didn't get to deduct the expense either. With the reauthorization there, the Economic Aid Act, it clearly specified that the loan proceeds are not taxable income, but the expenses are deductible. So you have the best of both worlds there. What I'm going to tell you applies to loans that are now an activity or actions that you take through March 31st. And if you're looking for more money, it's March 31st or until the money runs out. There is an article, again, in our economic and policy update on the PPP program, and there will be one coming up in the next week or so on PPP forgiveness. Now, three options we'll look at, or three opportunities for you concerning the PPP. The loans made before December 27th, 2020 that have not been forgiven may be increased. If you've already received a PPP loan and it's already been forgiven, you can just not listen for a moment. But if you have not increased, you have not had that loan forgiven, then you may go back and take advantage of a calculation based on gross income instead of net farm income. You remember that gross income is before you deduct all the expenses. Net farm income is what's left over, and that could be negative. and that would have made you ineligible for a loan last year when you applied for it. Gross income comes from Schedule F, line 9, for those of you who are sole proprietors, those who are not a corporation or a partnership. You may be a kind of an entity, but you are filing a Schedule F, then you're generally going to be taking that line off, that number of gross income off of line 9. The maximum for a sole proprietor filing Schedule F who doesn't have employees is now $20,833. You may not get 20 grand, but based on the cap for the amount of gross income that you can claim, $100,000, the math works out to be $20,833. Is $10,000, then you're looking at a loan of closer to $2,083. For a sole proprietor who has employees, it's going to be that $20,833 plus the higher of your 2019 or 2020's monthly payroll multiplied by 2.5 or 2.5. So the maximum of $20,833 plus the higher of 19 or 20's payroll with some math applied to it. Second opportunity. If you didn't get a loan last time, now's your chance. You may apply for a first draw PPP loan. That's pretty good if you didn't qualify, or if you didn't think there was enough money for you to qualify to make it worth your while. Or if you had losses, certainly you go back and use the calculation now, the new calculation based on that gross income on line 9. You have to have been in operation a year ago today. And again, the maximum amount you could look for is the same as if you were trying to increase the amount that you borrowed or could have borrowed if you'd have had that loan in the first place. $20,833 is the maximum. That's for folks who have the maximum allowed $100,000 of gross income. Third opportunity is a second loan, a second draw PPP loan. So borrowers who received that loan in 2020 may be eligible for a second loan, even if the first loan has not been forgiven. The first qualification, having 300 or fewer employees, is probably not a problem. The other two we need to talk about. Before you can receive the funds from a second draw loan, you have to have spent all the funds that you received on the first loan for those authorized purposes. And we'll show you what those are in a moment. You have to spend all the money before you can get more money. All right. You also have to be able to show that your gross receipts for any one quarter in 2020 was less than, it says reduced by, but I'm going to say less than 25%, or at least reduced by 25% compared to the same quarter in 2019. Let me show you an example. If you look at this, all the way out at the right is the total gross income for 2019, for 2020, and the percentage. And you'll see that total income in my example is greater in 2020 than in 2019, about 5%. Doesn't look too good as far as fine, but you look in the second quarter, $17,000 of gross income in 2019, $12,750 in 2020. That's a 25% reduction. 20s in gross income is 20 than 20 first 3 quarters, last 3 quarters. If you want to shortcut the calculations, compare your gross income for 2020 and line 9 on Schedule F for 2019, and see, did you come up 25% less for the whole year? If you did, then you must have come up 25% less for at least one quarter. So by definition, you qualify. If you don't qualify, like my example here, go back and compare quarter by quarter gross income. If you come up with 25% or less, if you come up with a 25% reduction, you may qualify. The maximum, again, is the same as we've been talking about. There are two changes. One is for the sole proprietor without employees, well, for all sole and proprietors. The gross income is line 9 plus line B, and you know exactly what that is. If you sold cattle, if you bought cattle for resale, then you have a cost of goods that you deducted against the cattle. You get to count that, the cost of goods sold, whether it was for cattle or grain or whatever. That line, that particular line plus line 9, the gross income, is what you can use for gross income, up to the maximum of $100,000. For employees, you also add the amount of, well, you add the difference between gross income, which is capped at 100 grand, minus employee cost, plus employee wages. The math often will work out to be the same thing, as though it was simply the gross income, but not always. So they put that in there. It's a little twist that you'd have to go through, or you and the loan officer. Now, these PPP loans are forgivable. That is, you don't have to pay them back. And we already said that that forgivable portion is that loan is not taxable income. You have to use those proceeds from the loan. If you're a sole proprietor and don't have employees, you'd want to use that for owner compensation replacement. That is, you'd write yourself a check. If you got the maximum amount of 20 grand, you would write a check to yourself and put it in a different bank account, personal account preferably, and you would have met the requirements for loan forgiveness, for using the funds for appropriate purposes, authorized purposes. If you're an employer and you claim the PPP loan for the payroll cost as well, then 60% of the loan proceeds have to go to paying loan costs, or I'm sorry, payroll cost. The rest of it can go to rent or utilities for the farm, interest on debts that you had incurred a year ago or earlier, and for cost of goods that are essential to the operation. That's pretty open-ended, but you would have to be able to say that this was essential. If you don't pay back, let's say that you don't use, you're an employer, you got the loan, and you don't pay any of the loan proceeds toward payroll. Everybody left, or they're gone. You didn't use any of the loans to pay employees. Well, then 60% of the loan would be unforgivable. It would remain. If you, in other words, the maximum you could claim forgiveness for would be the other 40% if you spend it on rent, utilities, interest, and goods that are essential for the operation. In that case, you're still sitting on 60% of the loan. You have 5 years to pay it back at 1% interest, which is fairly low. You have to spend that money for authorized purposes we just talked about within either 8 weeks from the time the money is dispersed or 24 weeks. Normally, we would recommend the longer period, and those who didn't seek forgiveness early lucked out this time because they were able to either expand their loan or do something else with it. But that depends on how your monies go in your payroll and such as that. There is a simplified forgiveness application for loans that are not more than $150,000. Basically, I'm done. Here, I used the money. Here's my signature. You won't be required to submit documentation of how you use the loan. You're not going to have to send records of the 60% payroll or the interest that you paid or what utility bills you paid. You won't be required to do that if your loan is is $150,000 or less. But you must keep records proving compliance for the next 3 years, or 4 years if you have employees. And you may be subject to SBA audit. Again, the application ends March 31st of this year or when the money runs out. So by then you should have some idea of what your gross income is for this year, for 2020. We're going to look at another issue, shift gears to income tax, and something that came up, has come up a lot in my career and came up here in Kentucky last year. I got called in with some others in the Ag Econ department. Question came from Farm Bureau. Has the state changed their policy or the rules concerning deductibility of expenses, especially when there's no profit or when there's a loss, and or are they cracking down on this for some reason? And we reached out to folks that we know at the Kentucky Department of Revenue, and there didn't seem to be anything other than, of course, the state is looking for money, but that didn't seem to be a big problem. We also got a call back from someone within the Department of Revenue who checks up on some of these cases, asking what is the IRS's situation, what's their procedure and their rules when it comes to what some would call hobby loss or not for profit farming or businesses. And we shared that with them. And so I want to bring it to you for your protection and talk about that just a bit. The Internal Revenue Code calls this activities not engaged in for profit. We often call it hobby loss. There are 4 categories of activities as far as the Internal Revenue Code is concerned, and I've listed 3 of them because I don't think the third or the fourth one really matters to us right now. But there are business activities where the expense deductions are allowable. That's what most businesses are, and that's what your farm is in most cases. The expenses are deductible. Then there's hobby activities where the expense deductions are limited to the hobby income. Now, I had a neighbor who had a really nice bass boat and a souped up Jeep and trailer, and he had the sonar, radar, I don't know what else, and so many rods and reels, and he was all the time registered to compete in fishing tournaments, and he won sometimes. He could deduct his expenses, including depreciation, up to the amount of his winnings, but not anymore. So if he did well, he got to count some of it off, and if he didn't do well, he got a good suntan and he had a lot of fun. I also had another friend who had a John boat and I don't know, a 15 horsepower motor and a rod and reel he got at Walmart, and he'd just get in the boat and put out into the lake, and he'd fish just for the fun of it. It was personal activity and pure fun for him, and he didn't try to deduct anything because actually nothing would have been deducted. He could not have gotten any deductions for that as a hobby. General rule of thumb for activities not engaged in for profit is that you make a profit in 3 out of 5 years, 2 out of 7 if you're a horse breeder. On that 4th year, you may get a letter from, usually in my experience, from the Department of Revenue saying, we don't find evidence of a profit motive or something like that, but that we have decided to disallow your expenses for the last 3 or 4 years or however long, or disallow certain expenses up to the amount of your income over these years. Now they define that profit as I was just talking about a minute ago, it's the gross income, the receipts, minus the expenses and depreciation. And that would be the net income. If you look at the bottom of Schedule F, that's going to be your net farm income for tax purposes. A rule of thumb is a rule of thumb. It's not the rule of law, but it does open up the door in the 4th year of no profits for the department to come in and look at the situation and even to deny deductions for certain years or certain amounts. You'd rather not have to answer the question, but you need to be prepared for it. Okay. The determination of whether you're in this for profit or not is based on facts and circumstances. The code, the Internal Revenue Code and the regulations do not provide an absolute definition. You have the burden of proof in this case, or to say it differently, you get to say what the facts and circumstances are. You get to make the case for why all of your deductions are, all your expenses are deductible. It's critical to make this in a timely manner. That is, open the mail, read the letter, and make an answer quickly. The call that I got from the woman in the Department of Revenue dealt with a case where the farmer did not respond quickly, ran out of time, and it didn't matter, couldn't go any further. Once you run out of time, the time allotted by the department to prove your case, they're right. You can take it to court, but you have a certain amount of time to make that response and to make it conclusively. There are 9 non-exclusive factors in the tax code, the tax regulations. Non-exclusive means that of the 9, the first 3 don't have any more weight than the last 3. So 1, 2, 3 is not better than 7, 8, and 9. You don't have to have all of them. You may only have one that convinces the auditor, but they don't necessarily exclude one or two of them may actually be part of the same thing, all tied together. Here's the list, the first 4. It's how you carry out your activity. Are you carrying out your activity as a business? Are you acting like a business? Most of the literature you read about this is going to say, you ought to have a separate bank account for your farm. Okay, that's not necessary, but it would show, nor is it conclusive, but it would show you separate business and personal. Your personal stuff is personal, your business stuff is business. But it's also the way you treat the business, the way that you keep your records, the way that you document what you're doing, and the way that you behave when business changes. Cattle market goes up, it goes down. Soybeans are high now. Soybeans may not be in favor next year, but you look at the market and the market tells you plant beans and not corn, or you may look at other things here. What is it you're looking at, and are you changing your business activity with the changing markets? That's what they're looking for here. Do you have the expertise needed to do the job? Been farming all your life? That's good. Are you looking for other information because this stuff changes? Are you keeping up with the latest education? This meeting you're looking at tonight, this would be something that you're using as a tax advisor. I hate to call myself an expert, but you're looking at gaining information, education from somewhere else that you don't have. Document that. Keep the invite, write the name down, the contact information of the person who delivered the message, the date, the time, maybe show some notes. To your advisors, the people you're dealing with who are mentoring you, do they have the experience in this? What about the time and the effort that you spend? A lot of hours, a lot of work? Or do you have a farm manager who spends a lot of that time and effort into the farm? And are you contributing in decision making? Are you putting in what needs to be done to make a profit? Or just enjoying it? You're getting by with it. One of the things that you're going to find here, we'll talk about it in just a moment. The expectation that assets used in the activity may be appreciating in value. Your cattle may or may not be appreciating in value. Your tractors probably aren't, but your land very well could be. And that's something that is taken into consideration. I've made improvements to the farm. I've increased its value. I can show you tax records or appraisals, or at the time when the department asked the question, Can you show that it has gone up in value or will go up in value over time? Some counties in Kentucky, probably that's not true. Others are blessed with that or cursed with it. The values are going to go up. Have you had success in the business before? Have you had success in similar businesses? Or have you brought a business out of bad times in the past? So you haven't made a profit in 4 years now. Have you been able to turn around a business in the past? Have you got experience in these situations? They'll look at that. They're looking to see, can you get us to the point where you'll be paying taxes? And that is, you'll be making profits. They look at the history of income or loss. If you have little bitty income here and again and great big losses, that's probably out of balance as far as the profit motive. If it's really that way and you were depending on this, you'd probably do something else. The amount of those occasional profits, if any, what would that be? Your financial status. Have you got a lot invested in this? Are you at risk for a lot of the farm? And what's your outside income? You'd think that those with high incomes and big losses on the farm would be prime suspects for activities not engaged in for profit, and you'd be right. But it applies to all of us. And then elements of personal pleasure. And I started to talk about this a minute ago. You probably like your job. You probably get up in the morning and you say, I get to go to the farm. Not I have to go to the farm, but I get to go to the farm. And there's stuff you like about it. Probably really take pleasure in it. That doesn't disqualify you. But if that's all there is, it's just for your own pleasure, then it is a hobby. If it's a way of life that pleases you, but it's a way of making a living, then that can be a for-profit business as well. These are the 9 things that you'd look at. The IRS would consider all of them. You don't have to answer affirmatively on all of them. You may not have some of those, but you would want to answer the question with some very definitive numbers or words. You'd want to document everything you do. If cattle market goes down, you change, you listen to Kenny Burdine and you change your ways, you change your marketing strategy or something, document that. Listen to him on December 16th, and I changed my plans to doing this, and here's how I implemented it. And even though you still aren't making a profit yet, you've made a change and you can show that. Documentation is critical. And then that timely response. No response is a response, no, which means that the Department of Revenue is correct. You agree with them. Let's shift to depreciation. A couple of things that changed. Again, just reminders perhaps, but new farm equipment and machinery that you purchase is 5-year property. It depreciates out over 6 years, but we call it 5 years because you get a half year the first and the last year. Used equipment that you purchase now is 7-year property, just like it used to be. So a new tractor, a new hay rake, 5-year property, a used one, 7-year property. You see the difference in how quickly the asset is depreciated. All farm equipment and machinery now move to 200% declining balance as compared to 150% declining balance. You can see that it's a faster depreciation and it's weighted more to the front end. You get more of it in the early years, less of it in the later years. Now that doesn't apply to trees and land improvements and buildings and real property. And there are special rules on cars and trucks and vehicles used on the farm. There are 2 typical ways to increase depreciation on the farm if you need more expense. One is bonus depreciation, and that's still available. That's 100% write-off on the equipment, the machinery, the single-purpose ag structure, barns, and shops. It's an all or nothing. That is, all the equipment of a certain class has to use bonus depreciation or not. All of the barns that you purchase, or all of the certain class of asset has to come under bonus depreciation, or you elect out of it and not use it. So it's kind of lumpy. The Section 179 expense, you're now limited to $1,040,000 of fast depreciation or Section 179 expense, and it begins to disappear once your total purchases reach $2,590,000. So you add those two numbers together. If your purchases are over $3,630,000, you have no fast depreciation, no 179 expense. You don't qualify. That's not going to apply to most of us unless you bought a new facility or built something new. It can happen. You get to take each item individually. I'll take fast depreciation on this item, but not that item, even though they are of the same class. I'll take $1 fast depreciation. I'll take all of it. Anything between one and the whole thing, it gives you all that flexibility. So you or your tax preparer can tailor the tax return to your needs. What if you wanted to slow down depreciation? Well, there's three options. One is you can go to straight line depreciation. That is, I'll take the same amount year after year after year after year after year, instead of taking more of it on the front end. I can elect to take the 150% declining balance method rather than the 200%, which means that I take less of it up front, put more of it toward the end of the depreciation period. Or the alternative depreciation system, which combines the two. You use straight line over a longer period, typically 10 years for equipment. Okay, before I go on, this depreciation thing is kind of like those, I think those commercials for medication on TV, where they tell you, they end up telling you, ask your doctor if fast depreciation is good for you or your tax preparer. It's something to ask about, something to talk about with your tax preparer or tax advisor. We're going to look now at trade-ins and trade it in on a new one, and you would depreciate the boot on the new one, and that was it. The new tax regulations that came out in 2018 changed that. So there is no like-kind exchange for business property, what the Internal Revenue Code calls personal property used in the business, except for real estate. The like-kind exchanges have been eliminated. You can still swap this farm for this farm as a like-kind exchange and save a lot of money rather than sell this farm and buy this farm. The tax for deferred exchange has gone away on business assets. You now have to have two reportable events when you trade in a piece of equipment. The first one is the sale of the asset that you traded in. You used to not even do anything with that new, well, it used to be that you didn't do anything with that asset you traded in. It wasn't reported. It went through the depreciation schedule, but you didn't have to do anything with it. Now you have to report that as income. And then you have to turn around and depreciate the purchase of the whole value, the whole price of the item that's newly required. Let's run through some examples. The old way, you take a $397,000 tractor, you trade it, that's the one you go home with, that's the one you acquire. You got a $112,000 trade-in allowance on the old one. Under the old rules, the difference, the boot, was $285,000 is what you depreciated. Fast depreciation, bonus depreciation, any way you wanted to. Under the new rules, you have to first deal with the trade-in of the item that you took to the dealer, the traded-in item. In this example, the original cost $250,000. You took depreciation on it. There's still some basis in it of $61,262. You then take the sale, then you look at the sale price, the trade-in on allowance on the new tractor, $112,000. Subtract the remaining basis, $61,000, you have a taxable gain of $50,000. So you essentially sold that item for $112,000. You still had $61,262 on the books. You had to pay tax on the difference. That's the taxable gain. It will not be subject to self-employment tax. On the new item, it's very simple. You have to depreciate the entire purchase cost, $397,000. That's the depreciable amount. In many cases, you can just simply take enough depreciation to offset the sale of that new asset, of the item you traded in. In some cases, there's not enough income to do that. And so you have a taxable event when you traded in that item. A few miscellaneous items, a few income tax issues that we want to talk about here before we adjourn. Employee meals. Okay, the new law said that the meals furnished during working hours, we're talking about meals that are given to employees because of the meal period is limited. It's easy to say that in farming. If you're obviously if you're harvesting, if you're getting up hay before the rain comes, we don't have time to take the 2-hour lunch. Don't have time really to stop. We may just simply give them a bag of barbecue, hand it up into the cab, and let them go on. Employee meals also, we would look at meals furnished during working hours because of a remote location, because the nearest restaurant is a long way away. These, in 2020, these are deductible to the extent of 50%. You may deduct 50% of the meals you have paid to employees for these two reasons. For 21 and 22, the Trump administration made these deductible to 100%. 100% of the employee meals for 21, this we're in now, next year's tax return, and 22, if the meals are provided by a restaurant. Doesn't have to be delivered, but we're not talking about making bologna sandwiches back at the house and bringing them to the employees. I will say that Congress, the current Congress, many in Congress have shown that they are very much against employee meals. Not because of what you do, but because it's easily abused in other business. Taxability of government payments. Government payments are those things that come in on a Form 1099. It says certain government payments on them. They're generally taxable and should be reported on Schedule F. There's a whole long list of those. I'd be glad to share with you. I may have listed those. They're reportable on your tax return. If you are receiving Social Security or Social Security disability and CRP, you don't have to report the CRP. Oh, I'm sorry, you do have to report it on your tax return, but you don't put it down as taxable income. So you don't have to pay tax on your CRP income if you are receiving Social Security. And as I told you earlier, the PPP loan money and the EIDL advance grants are not taxable. For those who have employees, there were a number of COVID-19 related employee issues or opportunities. There was an emergency leave that allowed you as the employer to get a credit for payroll taxes when you had to give your employees leave because they had COVID or were treating somebody with COVID, or that emergency paid sick leave act that said my children don't have school or daycare, it's gotten canceled because of COVID, and you could give them time off and or pay to do something. Basically, you were given some tax benefits there. And then the Families First Act gave employers and self-employed persons, self-employed people, that would be sole proprietor farmer, credit for providing the leave. And you may, as a self-employed person, be able to take some credits there. And finally, for the first time, farm employers became eligible for the employee retention credit. That's been around for a long time. As far as those of us who work in tax on the farm, we've been pretty ignorant about it until it became available to farmers on December 28th, retroactively for last year. So you could see a great deal of benefit, up to $5,000 credit per employee toward your payroll taxes. I'd be glad to answer questions. You have my contact information here. You can email me, you can phone me, you can text me. I'd be glad to take questions or answer you now or later. I really miss seeing your faces and hearing the conversation. I guess you hear that a lot, but I hope that I have not strayed too far from the script and that I've helped you out with that.